The Hedgeless Horseman here. It's April 27, 2022. In this video, I'll talk a bit more about my overall strategy and how I think one should think during times like this, and why it really makes little sense to be fearful. First off, I got a pretty good question here on a previous video of mine. Basically, he's asking, but what is your overall sell strategy, especially considering the valid points you make about insane fundamentals favoring gold? Will you sell a certain percent at the greed level and keep a certain percent for the huge ride to fear of need levels? Or are you expecting the 2011 type levels to cash out the majority? I mean, that's a very valid question, a good question. Simple answer is I don't know, really. All I know is that there's no way I'm selling anything down here. I'm trying to buy as much as I can. And like I think I discussed in a previous video, around this point in time, March of last year, I thought about buying an apartment. But then juniors just kept going down, basically. So my opportunity cost was obviously increasing because, like I harp on about, price is what you pay, value is what you get, and this is a sentiment-driven market. So as price went down while value didn't go down, the opportunity just increased. So the opportunity cost of buying an apartment just kept on going exponential. And right now, for example, I do want to buy a new apartment, but I'm not ready to sell securities, sell assets, sell ownership of projects, etc., that I expect to go up 2, 3, 4, 500% on average next time we hit greed levels in the junior space. That's just, I mean, even with massive amounts of leverage in an overvalued housing market, that's not a good opportunity trade-off, in my opinion, because obviously, for whatever amount you put in an apartment today, if you wait and put that amount or use that amount to put in an apartment in next 2 years, let's say, when sentiment might be a lot better, you could upscale your apartment maybe 3 times over, depending on what the price of real estate, etc., does at the same time, obviously. And what's even kinda, I would say, better is that let's say rates continue to go up, borrowing costs continue to go up. Obviously, you can borrow as much as easily as you could when rates were close to zero. But at the same time, I mean, if that takes down prices, because most people use massive amounts of leverage, obviously, to buy housing. But if I sell some of my real unlevered assets to buy an apartment, for example, maybe prices have fallen by 30%, but I can put in 300% more upfront capital, let's say. Then I don't even need to borrow that much, and my risk will be more muted because I don't have that much leverage on the apartment I'm buying, obviously, because I put up a lot of cash directly. But the simple answer is I don't really have a major plan, because I mean, I'll continue to buy securities as long as I think they're undervalued. I mean, that's, like I talked about, that's my only condition. If I don't find a single mining company or junior in any metal, whatever, at least within my circle of competence, then I guess I'll have to do something else, perhaps. But I doubt there will come a time where everything is expensive, or at least that there's no opportunity. And I'm gonna show you what I mean by that. Take this GDXJ chart, for example. I mean, I keep talking about sitting on paper losses. That's not really, I mean, people treat that as a mistake. Maybe I should even use this one. Is probably even better. That paper losses is automatically a mistake. Basically, at any point you buy and it keeps on going down, you made a mistake. That's how people really treat it, and they don't think that, oh, I can't be down 50% and do well or whatever. I mean, just consider this trading sardine short of Bear Creek Mining. I mean, that's the purple line here. Obviously, you can see this zigzag pattern when we go from fear to greed, cheap to expensive, cheap to expensive. So if you assume that, like, I mean, this is obviously a proxy for sentiment, etc. But if we assume that Bear Creek Mining is just going to keep on oscillating basically between somewhere between these levels, and sometimes it will, become extreme in one direction and extreme in another direction, etc. I mean, how I think you should think about a profitable decision or profitable buy, let's say. I mean, if you consider this period here, for example, that's slightly below the mean level, and if anyone buys here and they see through this, this is what they're looking at, so they think I obviously made a mistake, or this was a bad buy. But again, since sentiment always changes, and this is a proxy for the sector overall, I mean, if you actually had held out to the next top, that would be an 83% return between, let's say, September 2014 to June 2016. So that's still 84% in less than 2 years. That is not a bad result. Obviously, most people, don't get out here, and that's why I personally don't like trading sardines, because in that case, timing is actually quite important, because you're no better off if you miss this, let's say, opportunity. Sooner or later you'll be back to this and even negative from where you purchased. Then you go up again, and then you could get said 83% return, but it would have been taking you 6 years. Then it's not a really great returns anymore. But obviously, if you sell some up here and buy more down here, etc. I mean, you can just basically sentiment trade a trading sardine. That's obviously possible. Just look at Bear Creek Mining. You can obviously do that. You could make a strategy just based on Bear Creek Mining, pretty much. But the point of this chart here is that as price goes down, while value does not go down, typically, at least not on par with price, what happens is the future returns, and you see the percentages there, they just keep going up. So even if this was a really good buy, and whatever happens after, before it actually goes to next sentiment high, that's pain, but it's still not a mistake, because again, if you just held on, you would take this route to an 83% return. If you bought down here, you would take this route to a 200% return in less than 2 years, less than 1.5 years. If you bought down here, you would take a 350% return and take this route. So it's just the cheaper it gets, and that goes for any story, obviously. When sentiment takes everything down, the future returns go exponential. Down here, it was a 572% return in less than, what's that, January to, in half a year. So I mean, you don't need to put in a lot of money down here to boost the original 83% return. And this again is a trading sardine, but let's look at GDXJ, which is, let's say, it's a proxy for a growth stock at least. So here you have the trend, value trend pretty much. Let's say this is a proxy for a growth stock. I try to look up Great Bear because that's an even better example, but it's not trading anymore, so it's not listed. So basically, think of these. If you have a long-term picture, if you buy something that you think it has probable growth, I mean, that's what I keep talking about. I like probable growth, because that means if they have probable growth, the company should be valued, or the products, etc., should be worth more in value 1 year from now than it is today. So you have a upsloping trend line. And you see these bottoms, for example, they are higher up, the tops are higher up. And in that case, I mean, if you buy high, for example, if you buy this top in 2016, let's say in 2023, it's going to be up there. I think it's going to go higher, but it's like, I mean, obviously since it overshoots the trend line. So actually, let's say it's going to go up here at next sentiment peak. Then that's a 45% return in, let's say 7 years. That's obviously not that great. But it's still, you're still not losing money at least. I mean, you're compounding, but at a slow pace. But look at how the future expected returns, goes up as sentiment goes down. And here it's obviously way below the trend growth. And the future return goes out up to 175%. So that's how, I mean, like I do, I buy all the time. I buy every month. Typically in growth stocks, high quality growth stocks that has a lot of room to run. And I think you should be focusing on the value creation trend, because that's not what anyone focuses on. Most people focus on recent past and immediate future. That's obviously the wrong way to go about it. I mean, take SK for example. I mean, what has happened? Nothing has happened with the projects. This is still, one of the best exploration stories out there. Huge land package, 85% of the SK Creek district. Gap has closed. Private placement has closed, but the warrants are running out, or one portion of warrants is running out in August. So I think people are, I mean, there's obviously panic sellers as well. I mean, you've seen that in any top tier store. People are selling, for whatever reason. I don't even try to figure out why. So this is probably mixed in with artificial selling, because I have to exercise some warrants myself, and I haven't sold any to do that yet. And I might actually sell some other stock to cash in on and acquire more shares of SK Mining. But this is, I believe, artificial selling as well. And this is a bit how I think about SK Mining. You have a bunch of future scenarios. You have you have TV, which I think alone could pretty much be a company maker. Then you have a scenario where TV and Jeff grows, for example. Then you have TV, Jeff, and Scarlet Ridge, and like you can see here, I mean, they're gonna do follow-up holes at TV. Obviously, they're probably gonna drill C10, Jeff North, Jeff South, TV North, TV South, Excelsior target, Scarlet Ridge. So, what I like about growth stories is when you can aim big and miss big. Because obviously they're going to be testing a bunch of targets, and if they hit something, or there is a valuable deposit at every one of those targets, etc., SK is going to be absolutely huge, obviously. Then you might have, follow this value creation trend for a while. But if half of them hit, maybe the value trend will be something like this. Obviously, there's going to be seasonality, etc. But in that case, let's say my base case is something like this, then these returns, for example, I mean, if I bought here, let's say I don't have a date, but let's say in a year, then I think I'll have I think it will be higher, but anyways, like, okay, then I would have 140% return because the story hasn't changed at all. But as price goes down, I'm getting more and more expected future returns at any purchase going down. And you see how quickly, I mean, that can go up from a theoretical 140% return on any buys here to 300% returns. And then we again can adjust based on different scenarios, etc. And if you draw out the timeline, etc., then it can swing hugely. But the point being that as long as a case is intact and there's like probable growth, etc., you do not want to sell when they go below. Not that one. When they go below the value creation trend line, for example, because it's just going to speed up. It's going to speed up. Maybe this was the best. It's just going to speed up your returns, because obviously if this is the base case goal here, for example, I mean, this bottom buying here is great because that's 175% returns in whatever time period. This is obviously an even better buy because that's same amount of returns but in a even shorter time frame. And down here is obviously massive returns, and this bottom is probably gonna be even shorter. It's akin to like in Bear Creek Mining. I mean, if you bought here but you didn't sell here, but you were planning on selling here next time, you would obviously want to be in here because that's the same amount of gains in a shorter time period. Maybe I'm a bit off point here from my original point, but take Caser Gold, for example. I mean, everything has been selling off lately. Again, even the absolutely best stories out there, and that's why I can't figure out why people are afraid. It's like when you see some of the best exploration stories out there, the top like 1-2% of exploration stories selling off 35% or whatever. I mean, how can you not see that that's a gift? Gold is rare. A prime project is much rarer still. The tier 1 projects will be tier 1 projects, first in line to get into production or acquire whatever the price of gold does. A high margin mine is going to be even perhaps more valuable to companies as if the gold price would come down, for example. So like if you buy the best of the best, there are no other options. There's not an abundance of good projects out there. The best projects will be the best projects regardless of what sentiment is or what gold is doing. So when you see a bunch of high quality stuff sell off, like what's the fear here for Caser, for example? I mean, people say it can go down lower, for example. Yeah, sure. Let's say it drops 50% more and it's trading at, I don't know, an enterprise value of 20 million, for example. I'm not sure that would be 20 million, but for just as an example. What are you afraid of? That forever forward, the best cases are going to be valued at 20 million in enterprise value? Of course not. I mean, the sector itself is more valuable than it has been in quite some time. I mean, it's an irrational fear because anything can go down in price. The risk is that it should go down and stay down. And at some point, if everything drops 50%, there's going to be stuff out there that's trading at an enterprise value of 0. So unless, again, you think the sector is going to go away or whatever, that's going to become a multi-bagger in the future. So basically that's like, take Bear Creek Mining, for example. It can always go down in price, but sentiment always changes and makes it go up in price. So it's just a matter of degrees of better and better buys, better and better buys, better and better buys. So when people are more inclined to sell, that's when obviously they should be buying hand over fist, buying hand over fist, buying hand over fist. Like now, for example, people are looking at hindsight. They're looking at this and then projecting. This doesn't matter. This is the past. Now it's a lot, by definition, a lot better buying opportunity than here, and better than here, and better than here, and way better than here. This is not rocket science, and that's why I personally like growth companies. Like take Casio for example. Nothing has changed. Price has gone down 35%. So if you bought here and you believe that this is the expected value trend and it's gonna oscillate like this based on sentiment, etc. Let's say this is in 1 or 2 years. So if you bought here, even though you're down 35% now, you're gonna have an 80% return, which is great. I think it's gonna go higher than that, but whatever. Let's use this as an example. It went down 35% first, but you still get your 80% return because it goes something like this, for example. Whereas the people who were selling down here, they lost out on a 173% return, a much better return, over double that return. So it's like I'm buying cases like this, intact growth stories, top tier growth cases that have gone down in price, where the value creation trend and growth trend is very much intact. And Casio, for example, I think they haven't yet closed it, but I expect them to close the placement soon. So if I look a bit further ahead, then I realize that I'm gonna get paid to wait, and the longer they can just keep growing, the longer I wait, the returns are gonna be absolutely massive. Because if my time horizon is 2 months from now, it might go down or it might go up. But whatever, it's gonna probably move in a not that big of an amount to a large degree. But if I allow these cases to flourish, because you can't obviously prove up 3 million ounces in 2 months from 1 million ounces. But if they just have a upward sloping growth profile, if they keep drilling and keep hitting, etc., the value is gonna slowly but surely it's gonna grow and grow and grow. And the longer I hold the stock, the more the value, all else equal, will have increased, and my future expected returns will go up based on time frame I'm able to hold it. And again, then you can see how massive the returns, the future expected returns, change depending on price levels. So that is why I am incredibly bullish right now, especially in stories that have not changed for the worse at all, and there is a lot of upside potential still. Because again, depending on what scenario happens for SK mining, for example, I mean, it can of course go to zero. I mean, any stock can go to zero. That's not the case, but I want to hold the ones that could become 5-baggers over the next 3 years, let's say. And some will be have an even higher return than that, but maybe more targets missed than I thought, and it becomes a 3-bagger or a double, and a double would still be great. And then you can understand how the implications of the paying as low as possible in light of all the future possible scenarios, that's going to change immensely. So it's like, okay, 600% there, but versus here 329. So I mean, again, this is why I keep harping on about selling low is the absolutely costliest mistake anyone can do, and that's the one mistake everybody does all the time, over and over. People get annoyed. Some people get annoyed by me being bullish right now, because how can you be bullish? You sat through a 2-year correction. Yeah, I've sat through many 2-year corrections, or some are even less than that, but on the order of 50% or higher. I mean, if you sat in Casser Gold, for example, you're down 35% from this level in like 1 or 2 months. How is that not frustrating? How does that not look bad? I mean, a minus compound rate of like 35% in 1 to 2 months, 1 to 2 months. But that's not what we're after. I mean, this is just the market being the market. We're waiting for the next sentiment high, obviously, because that it's always going to happen. You have these zigzag. Obviously, best buys are at the lows, 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 lows. So, and like I showed, it has huge impact on growth stories depending on your the growth rate. That's why I like growth companies and do not prefer optionality plays or mature trading sardines. Sure, you could actually trade this, but on the point though, someone asked me about, when are you going to sell, etc. In the case of a trading sardine, you actually have to time. But in a growth story, let's say, you might not need that much of timing. But obviously, if you combine that with just simply buying when it's undershooting the value trend, that's obviously great. And right now it typically happens when sentiment is absolutely brutal out there. When everybody wants to sell and nobody wants to buy, that's when the future returns gets jacked up exponentially. So that's why I keep hammering on this point. You can buy highs, especially in growth stories, as long as you buy more during the bottoms. Because even this top had a positive return here, but these lows here had massively better returns. 240% in a few months, 150%, 250%. This returned 24% in 4 years. Not great, really, but it's like you don't need to go down that much in order for that to be an actually acceptable return. Let's say, who knows, 65% might actually be a pretty. I should have brought in a compounding calculator. I forgot that. But it's like if you just calculate what this compound rate is from beginning of 2017 to late 2020. So like in 4 years, not massive returns, but let's say that's like, I don't know, 10% per year. That's still pretty much what the market provides on a very long term. I mean, the overall market. But obviously, if you buy the lows here, I mean, your returns get juiced up so much, and that's why it's like you don't need to be a surgeon right now. Some people, and I used to be very against diversified portfolios. But right now, when everything is cheap, the cost of diversification is very low. So if there was a time, I think, you can really afford diversification, it's down here when everything is cheap, because that's going to ensure you at least to survive to the next upturn, because the tail, we have the risks to the upside. Up here you have the risks to the downside, the macro risks. So if you're diversified, your whole portfolio is probably going to go down a lot. But from here, the whole portfolio, even if you're diversified, is probably going to go up a lot. So at these points, when we're closer to greed levels, then I think you have to be more of a stock picker, because there are fewer and fewer companies out there that are trading below their value and trend growth. Most will be up here. So even though they'll probably on a long enough timeline, if they are a growth company, you'll probably get bailed out, but you'll have some heavy paper losses in the meantime. But if there's some companies that instead of trading this far above trend growth, let's say they're trading here, that's still better. Even though that it won't be perhaps massive returns going forward, but maybe they'll go down, etc. And some that don't go down as much, you can trade into a company that's gone down even more. So you can do reshuffling. Again, main point, I guess, is that always think about sentiment and the signal in case of growth cases, and just be well aware of how if you have a longer time horizon, how the future expected returns change enormously just in like a 35% correction in 2 weeks. Those are massive. I mean, in my opinion, that's why it's like for the people who are selling at these lows. And sure, if you sold this and you sit and watch this go through, then you're like, yeah, okay, I didn't make a mistake. No, you could have held it from here and still had a 200% return. And if you sold here when it was already low, you're probably not going to buy back until this point in time. So you get a 50% return, and then you're going to see through the next one and sell low again and buy high. But the ones who are like, in my opinion, we're way past the point of trying to pick a bottom. Way past that, in my opinion. The ones who are waiting and trying to pick a bottom, it's like, good luck getting a... I mean, when do you know a bottom is in? Many people thought this was the bottom, obviously. So if you waited until you got this upshoot and broke, if you made a trend line like this, okay, yeah, now we're on again. So you start buying here, and then you're at a loss again. So then you're selling because the bottom isn't in. I'm just buying because I'm waiting for the big upswing up all the way up here. So even if this continues for 6 months or whatever, and juniors are just top tier juniors just get cheaper and cheaper, stay as cheap. Maybe I'm down 30% in my entire portfolio, whatever, and I'm just buying and buying and buying. I will have amassed a huge amount of shares, so that when the next 200% return comes, I could probably retire. Because the future returns are extremely high on any dry powder used right now. So the longer period you'll have dry powder, that means that, okay, if we expect a 200% return from this level sometime when it reaches this. I mean, first of all, that's so good returns, you could wait for like 4 years and that would still be very well worth it. But let's say you just plow in more and more money. So every dollar invested is going to become $3 within 1, 2, 3, 4 years. You don't find that in many sectors. You certainly don't find that in your bank account. So this is the sowing period, and that can there are better and better sowing periods, and they can continue for longer than most people can stay sane. But I will just point out that selling below trend growth and below value, etc., has massive implications. Let's say Casio drops down here and the case is intact. That's 400% theoretical. So anyone who's selling there is giving away 400%. The one who's buying is getting 400%. And the one who just held from this level will still get 100% return. But he can boost his future returns by adding more and more dry powder. So the buys down here, even if it was just 10% of what he owned here, that's still gonna get 400% on his 10% position, which is gonna boost the overall portfolio returns a lot. So I'm just saying that the cheaper these top tier projects, etc., get, I mean the cost of selling is going absolutely bananas. assuming you could actually hold out for the plays to play out. So that's why I know this. I understand this. That's why I have been talking about. I'm way past the point of selling, and any juniors. This is chronic buying period for how long it takes until sentiment turns up again. Because the future returns are absolutely massive. They're getting steeper and steeper and steeper and steeper and steeper the lower it goes. Sure, we don't know when it will actually. I mean, it might have a slope like this because we're not going to hit a sentiment high until this, but it's still getting steeper and steeper and steeper. Because that means more future returns in a shorter period of time. Because for every passing day, the correction continues. That gets us one day closer to the upturn. So what you do during these times will have huge impact on your long-term results. Absolutely massive impacts. And the people who throw in the towel and get annoyed by me being bullish, they simply do not get it, and they will probably never have great returns. I mean, I think there are people who've been in the market for 2-3 decades who don't really get it, and there are some who's been in the sector or investing for like a year, and they get it immediately. So you have to start getting this. You have to start appreciating the power of compounding and how extremely expensive it is to be making mistakes near the lows. And not to be, in my opinion, one of those greedy people who are waiting for the absolute bottom to come in and they think they made a mistake anytime they have a paper loss. This wasn't a mistake. I mean, I actually bought Bear Creek Mining around here, I think. No, actually, maybe here. But that still went down like 50%. But I sat on my shares, and I think I bought more. And I ended up making 500% from Bear Creek Mining. Even though I started off with minus 50%. The costliest mistake would have been to sell, because I just gave away 500% returns, future returns. I hope some of these concepts are starting to sink in, because I do not like seeing people not appreciating the opportunities that are presented to them and believe this absolutely imbecile of a Mr. Market, believing that top tier projects just went down 35% in value. No, they did not. They went down in price, and most of them have gotten better or are still quite intact. So they're gonna go like this. And obviously you want to sell when they're cheap. The cheaper they are, the better the future returns. The worse the sentiment is, the better the future returns. Long rant again, but it's like I don't go into too many specific juniors lately, because in my opinion, these concepts are way more important than stock picking. If you start to understand the power of sentiment and the time value of getting paid to wait in a growth company, and you understand how obscene that the opportunity and the opportunity cost of selling is going exponential and not linear during these bottoms, that will help you a lot more than me giving you exactly, I think you should buy this stock, for example. Because these concepts you can translate to any market, any sector, because any sector or any market that involves humans will have these patterns, will have these mental flaws people do. And that this is how you take advantage of it. You're front running a different future. You're playing 4D chess, basically, where everyone else is playing checkers, basically looking at the past and just making assumptions of the future. Now we know that the best is yet to come based on where we are and what has happened. The worst is not yet to come, because the worst has already pretty much happened. Up here, the best had already been. Now the worst has already been. So these are quite simple concepts, common sense concepts. But 95% of people will never uh, incorporate this. They will never, quote, get it. Just be aware of how, again, obscene, uh, how obscene an opportunity can become in just 2 weeks, let's say. And again, as long as the case is intact, we're not going to stop mining. There's not going to be the market. The junior sector is pricing in a higher likelihood of asteroid mining happening than the whole fiat system collapsing. So I have never seen risk reward like this. The Mr. Market is absolutely bonkers. It has no idea what it's doing. So stop worshipping it. Use it. Use other people's extremely costly mistake by front running what they're going to do in the future. Because the ones who are selling, obviously, the ones who are selling down here are the ones buying back up here. So the ones who are selling these dirt cheap juniors right now, they're going to be chasing it when you can sell it to them later. Thanks for listening. Consider me biased. SK Mining, which I used as an example, and Caser are sponsors, and I own those two companies. Do your own due diligence. Thank you.